Vanakkam, Namaskar, and hello to all the viewers and listeners of this edition of Fixed Income Markets with Sundaram Mutual Fund. The domestic economy continued its strong showing, with most of the month being data light, while month end we got the most of the important economic data. The inflation at the headline continued to get influenced by the food items like vegetables, pulses, rice, and spices. Although the core continued to moderate, showing that food inflation continues to remain the single most threat to inflation. A supply side response is a more appropriate response for this. In general, RBI has been high alert on macroeconomic stability and thus inflation. The central bank has taken potential measures to tighten the growth of unsecured portfolios of RBI regulated entities by increasing the risk weights on that part of the lending, thus potentially dissuading the lenders to focus big there. On inflation front, RBI has kept the liquidity in the system on a tight leash, thus avoiding the de-anchoring of rates from the signaling repo rate currently at 6.5%. In the upcoming policy, we expect MPC to stand pat on the rates with retention of stance of withdrawal of accommodation. As we have seen that food inflation still continue to be in a zone where it can impart an upward bias, particularly the tur dal YOY inflation at 40%, rice at 14%, onion at 97%, and tomatoes now again in inflation zone at 29%. And a lot of uncertainty on international crude prices, where the suppliers of crude are looking to keep the prices on an upward zone. The trade deficit has been trending upward and can exert pressure on the rupee, although all other external indicators are healthy. And this particular trade deficit number could be idiosyncratic also because of the wedding season. The gold imports contributed a large part to the trade deficit. On the global front, the Federal Open Market Committee minutes confirmed the thinking of the several members that policy rates were restricted enough, although inflation was still high, but financial conditions were tight enough to bear on consumer sentiments. The recent set of data in the United States has been mixed, but better than expected, and the soft landing narrative is looking more likely. But we believe that slowdown is likely to deepen as the excess savings built during COVID times is on the verge of running out. And as we exit the festive season, we expect a more pronounced slowdown. The only caveat to this is that the US government keeps on spending before the presidential elections, and that keeps the economy supported. As already highlighted, United States public debt is weighing it down, and rates can stay higher for longer. In China, state is doing everything possible to get the economy on track. Although, as we indicated, they are not very keen to cut rates unilaterally. They have been more focused on providing supports through other measures, and it will take them some time as the approach taken by the state is a cautious one in a polarized global setup. Europe continues in the slow zone, although inflation is yet to be conquered, as in the most G7 nations. Japanese yen has stabilized around 145 to 150 levels to the dollar, and the market expecting more tighter policy orientation from the Bank of Japan. In India, two sets of data, one on FY24 quarterly GDP at 7.6%, surprised on the upside as most economic expected a number around 6.8%. The surprise came from the manufacturing front, and the second set of data on inflation at 4.87% was almost in line with expectation of 4.8%. The core inflation declined to 4.3%, but both these data sets point towards a cautious approach from the MPC to keep the inflation towards the target of 4%, as we have an upcoming general election next year. With state election win in favor of the ruling party for the larger states, Our vigilance on delivery of center scheme and price control will be paramount. This can entail more revenue spent than earlier envisaged in the budget. Based on this, in a continuation of our earlier stance, we recommend active mid-duration buckets as a preferred route of investments on account of better price discovery due to liquidity, which results in a better capture of interest rate moves. Products which we have in our basket are Sundaram Short-Term Fund, Sundaram Corporate Bond Fund, Sundaram Banking and PSU Fund. Keeping this in mind, we recommend investors to take positions in mid-duration buckets if they have 12 months to 18-month horizon, and investors with conservative risk appetites match their investment horizon with duration of the product or take position in conservative products like liquid or overnight. Thanks for joining us in this episode. Looking forward to see you next month.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.